Inflation's running hot, and to help you keep up, the Canadian government has just lowered taxes, well, more like shifted buckets. To help Canadians keep up with inflation, which has been running at historic highs for well over a year, the federal government has adjusted tax brackets for the 2023 year. Each bracket saw a slight adjustment from the previous thresholds, which means you'll be paying a lower rate of taxes on more of your income, and the new tax brackets are: up to $50,000 in income, you'll be paying a tax at a rate of 15%. Income between $50,000 and $100,000 is taxed at 20.5%. Income between $100K and $155K is taxed at 26%. Income between $155,000 and $221,700 is taxed at 29%. And income above $221,000 is taxed at 33%. This is overall positive news, as this should save you taxes right off the bat with your very first paycheck in 2023. Now keep in mind, these are federal tax brackets. To get your overall tax rate, you'll need to include your provincial tax brackets on top of the rates I just talked about. Here's a quick example to show you what the figures would look like. Let's say you live in Ontario and you have an annual salary of $90,000 and you are paid twice a month, meaning there are 24 pay periods in your earnings year. In 2022, your take-home pay after you take away taxes, CPP, EI, and all that fun stuff, your paycheck would be roughly around $2,690. Now, in 2023, with the new federal tax brackets, your take-home pay will be around $2,704. That means you end up with an extra $14 in this example per paycheck per pay period. Not a whole lot of money, but hey, that money is better off in your pockets. The basic person amount, or the BPA, this is a non-refundable tax credit that can be claimed by anyone who files income taxes in Canada. Essentially, this is the amount of income you can earn without having to pay any federal income tax. In December of 2019, the government announced that they'll be increasing the BPA annually until it reaches $15,000 in 2023. Now, thanks to this new legislation, the BPA for 2023 has been set at $15,000, meaning you can earn $15,000 and not have to pay any federal income tax in 2023. The First-Time Homebuyers Tax Credit, also known as the HBTC, this is a federal government initiative aimed at making homeownership more affordable for Canadians. Due to new legislation that was announced in December of 2022, eligible first-time home buyers can now claim a $10,000 non-refundable income tax credit, double what it was before, which results in tax savings of up to $1,500. The $10,000 credit is multiplied by the basic federal tax rate of 15%. That's how you get to $1,500. I mean, sure, if you're buying a Toronto condo or a Vancouver condo for $700,000-$800,000, I'm sure this $1,500 is really going to make homeownership more affordable. Maybe not really, but hey, it's money better off in your pocket. Now, unlike other tax credits and tax benefits where you have to have a separate application process, there is no need to apply separately for this HBTC. All you do is just enter the home buyer's amount of $10,000 if you qualify on line 31-270 of your income tax return. This credit will result in a rebate on the taxes you owe. Now, if you don't know how to file your taxes, or if you don't know where line 37-270 may be, or how to even enter this home buyer's tax credit, make sure you watch this video where I walk you through step by step on how to file your income taxes online for free every step of the way. Old Age Security, or OAS. This is a government program designed to help retired Canadians with a source of income throughout their retirement. Now, seniors who make too much money or have too much income are sometimes asked to give a portion or all of their OAS back based on their income levels. And what are those income levels for 2023? Well, here they are. The minimum income recovery threshold is $81,761. The maximum recovery threshold for ages 65 to 74 is $134,626. The maximum recovery threshold for ages 75 and above is $137,331. In other words, if you make more than the minimum amount, then you'll be asked to give some or all of your OAS back based on your income level. Now, if you make more than the maximum amount, then you'll be asked to give back all of your OAS, or it might be entirely cancelled, simply because you just make too much money in retirement. Rules governing the Canada Pension Plan in 2023 are also changing. The maximum pensionable earnings for 2023 will now be at $66,600. That's up from $64,900 in 2022. The basic exemption amount will stay the same at $3,500. Employer contribution rates are also changing. They're going up to now 5.95% in 2023 compared to the 5.7% in 2022. So what does all that mean? Well, that means that every time you get your paycheck and you see that CPP line come off your pay stub, by the time 2023 is done, you will have contributed $3,754.45 to the Canada Pension Plan. And if your annual salary is more than $66,600 in 2023, that means every paycheck after you get to that amount, you will no longer see a line item deduction for CPP because you've maxed out for the year. Now, going back to my example of that individual earning $90,000 in Ontario, At that salary, your CPP contribution per paycheck would be roughly around $205. With the new CPP increases, your new CPP contribution in 2023 will be roughly $214 in 2023. Now, the good news is, even with the increase in CPP contribution rate, thanks to the tax bracket adjustments we just talked about earlier in the video, you still take home more money every single paycheck. In 2023, the amount you can contribute to your TFSA will also increase to $6,500. The TFSA is an investing account made available by the federal government to Canadians 18 and older. And what can you hold inside of a TFSA? Well, you can hold almost anything you like. You can hold stocks, ETF, bonds, mutual funds, and more. And the real beauty about the TFSA is that all the gains and all the earnings you make inside the TFSA are all tax-free. And if you want to take your money outside of the TFSA, well, that happens tax-free as well. TFSAs are designed to help Canadians save and invest their money, but they are a bit different compared to RRSPs, which I'm going to talk about in a little bit. You can contribute cash or investments to your TFSA with the goal of building on those savings or building up that investment, and all those investments and savings grow tax-free while they are inside the TFSA. Now, unlike the RRSP, you don't get a tax deduction when you contribute to your TFSA. However, when you take money out of your TFSA, there is no tax on it, unlike there is with the RRSP. The TFSA is designed for both short-term and long-term savings, unlike the RRSP, which has been mainly designed to save for retirement. Every Canadian that is aged 18 and up gets to contribute more and more money to the TFSA each and every year. The TFSA was first introduced back in 2009 with a limit of about $5,000, and that limit now has slowly increased with inflation. Take a look at this chart. You can actually see how much contribution room has increased each and every year since 2009. What this means is that if you had opened up a TFSA since its inception and were born in 1991 or earlier, your lifetime contribution room for the TFSA is now $88,000. But what if you recently moved to Canada? Can you still make use of the TFSA? Any individual that is a resident of Canada who has a valid SIN number, is 18 or older, is eligible to open up a TFSA. Non-residents who are 18 or older and have a valid SIN number can still open up a TFSA. However, any contribution you make as a non-resident to the TFSA, you'll be subject to a 1% tax each and every month as long as the contribution stays in the account. My recommendation is that if you are a non-resident, there is no point in having a TFSA. 1, you don't want to pay tax on the contribution. 2, based on your tax residency in another country, there could be a whole host of other tax issues. If you are a new Canadian and you are a resident and you open up your TFSA, your contribution room starts the day you open your TFSA. Let's say you became a Canadian back in 2022. That means your contribution room for 2023 will be roughly $12,500. You got $6,000 from 2022, you got $6,500 in 2023, so that's how you get to $12,500. And then next year, you got an additional $6,500 added to your TFSA contribution room, and every year the government announces an increase in contribution, you get that added on to your TFSA contribution limit. And if you don't make use of that room in any given year, that contribution limit carries over until you make use of it. The annual dollar limit for RRSPs has increased to $30,780 for 2023, which is up from $29,210 in 2022. However, keep in mind that your individual contribution is still capped at 18% of your earned income. You can contribute cash or investments to your RRSP and get a personal tax deduction on those contributions. What this does is that the contribution you make is a deduction on your personal taxes and often shows up as a personal tax refund when you file your taxes. Investments that you hold inside the RRSP, and they can be stocks, ETFs, bonds, mutual funds, etc., they all grow on a tax-free basis as long as they are inside the RRSP. Now, when you take money outside of your RRSP, that's when you have to pay taxes on that income. That income is then added onto your personal taxes, and you are taxed at your top marginal tax rate. To calculate your RRSP room, you have to know the 18% times earned income formula. Let's take a look at what that looks like. Most commonly, earned income includes employment income from your job. It can be business income from self-employment or a partnership. It can be rental income, but earned income does not include dividend or investment income. Bottom line is that your RRSP contribution room will be 18% times your earned income, up to a maximum limit of $30,780. Let's say you earned $80,000 in 2022. That means your RRSP contribution room for 2023 will be $14,400. Now, once you file your taxes, the CRA will process your tax return and send you something called a notice of assessment. That notice of assessment will also include the amount you can contribute to your RRSP in the upcoming year. Throughout the pandemic, the federal government provided a whole host of financial aid based on your personal situation. Some of these included the Canada Emergency Response Benefit, or the CERB, the Canada Emergency Student Benefit, CESB, the Canada Recovery Benefit, CRB, Canada Recovery Caregiving Benefit, the CRCB, the Canada Recovery Sickness Benefit, the CRSB, The Canada Worker Lockdown Benefit, the CWLB. There were a bunch of these benefits giving out, and you may have claimed some of them based on how your situation panned out. Now, if you received any of these benefits, the government will send you a T4A slip, which has all the information you need to file your taxes for the benefits you received. In some cases, if you made more than $38,000 in income in 2022, you might have to pay back some or all of your benefits based on what you received. And what happens if you decide not to pay them back? Well, that means the CRA has a right to your future tax refunds and your future tax benefits like the GST, HST credit until they recover all the COVID-19 benefits that they are owed. Now, in this situation, I would recommend if you cannot pay the full amount, you reach out to the CRA and arrange for a payment plan. These were the major 2023 tax updates, but we're not done just yet. It's great to know all these updates, but how can you make the most use out of this information? The Canada Revenue Agency requires most Canadian citizens to file their taxes each and every year. There are a few exceptions, but generally speaking, if you are making money in Canada, even if you live in a different country, you will have to pay taxes in Canada. Now, how you make that money makes a huge difference on what that payment process looks like. Self-employed taxes, as an example, work differently than taxes for traditionally employed folk. Or if you are a Canadian non-resident, your taxation process looks different than Canadian residents. There are various online programs available that can help you file your taxes based on your situation. Now, if your situation is complicated, I definitely recommend reaching out to a tax professional to help you prepare your taxes. But no matter how you file your taxes or what your personal tax situation looks like, there are rules that apply to everybody and you need to keep these in mind. For example, file your income tax on time to avoid penalties. The deadline for most people is April 30th, 2023. Make sure you claim any tax credits that you are eligible for. Take any tax deductions you will qualify for. Maximize your RRSP if you can, but don't go over. Maximize your TFSA if you can, but don't go over. I have detailed videos on all these topics and more. How to file your taxes, how to make the most use of your money, how to maximize your RRSP, your TFSA, things to avoid, taxation mistakes to avoid, tax tips that you need to know to make the most out of your money. I will leave links to everything I've talked about and more in the description of this video. I'll leave links in the comments of this video so you have access to everything you need. Thank you so much for watching and making it to the tail end of this video. I also have links to exclusive offers for you in the description as well. These are products and services that I use on a daily basis, and I really want you to at least try them out. You might find something you like. Make sure you hit that like, subscribe, and thanks button on the bottom of this video. That's it for now. I'll talk to you in the comments section.